Do you also take a trade every time after a breakout, only for the market to start moving in the opposite direction? While breakout trading sounds easy, in reality, without the right system and psychology, it can be quite deceptive. Breakout trading made easy shatters this misconception and teaches you a simple, practical, and tested method to avoid false breakouts and profit from real ones. In this video, we'll cover the true definition of breakouts, entry-exit strategies, and the mindset that keeps you from giving up too soon. Breakout trading is all about capturing the energy generated when a trading chart breaks out of a pattern's boundaries to make a profit. But remember, it's not about gambling, it's about recognizing the pattern and mentally preparing yourself at that very moment. The biggest appeal of breakout trading is the feeling of momentum. When a breakout happens, both buyers and sellers jump into the fight simultaneously. But the real trader is the one who senses who's winning this tug of war and then dives in that direction. Now let's talk about confirmation. People think you should enter as soon as a breakout occurs, but the book says that the price can change the moment a breakout happens. So there should be a small step, like the price continuing to follow where our buy-sell zone was created from the breakout. This is confirmation. Learn to understand the value of time in the market. After a breakout, you should proceed after observing just 1 to 2 candles. This isn't rushing, it's securing your breakout strategy. Just as a business growth strategy first involves market testing, a breakout trader also knows how to take a small validation. This behavior also works in life. When we consider a decision like a career move or a major expense, and if the chart returns to the zone, then the stop loss or SL can trigger, and the trade can turn into a loss. Therefore, position size should be kept in a way that makes the loss psychologically manageable and keeps you professional. The book says that if there's a loss, you'll only be able to handle it calmly if it impacts your account by 1 to 2%. And when profits come, your confidence in your process will grow. Breakout trading has a hidden enemy, fakeouts or false breakouts, when the chart appears to jump but suddenly reverses. In such situations, many people buy out of fear at the peak and find themselves stuck in a decline. The book states, fakeouts are not your weakness, they are a test of your preparation. The best way to handle a fakeout is to wait and reevaluate. Just like a good marketing campaign doesn't go viral instantly, a true breakout takes time. Therefore, one should wait. The biggest lesson in this initial chapter is that breakout trading is more a psychological game than a technical one.
You can profit by getting your mind right, waiting for the market, and taking disciplined entries. Chapter 1, Part 2. Breakout trading is not a strategy, it's a mindset. When the lines on a chart break, it's not just a technical boundary that breaks. A trader's hesitation also breaks. And that's the first breakout, the one within the mind. The book says that when a stock breaks out after a long consolidation, it's not just a price movement. It indicates that a new trend may be starting in the market. And seizing that opportunity is the mark of a true professional. However, it's important to note that not every movement is a breakout, and not every breakout brings profit. Context is crucial here. If a stock is already at a high position and now shows more bullishness, the breakout might seem valid. But if the same stock suddenly rises a bit after a price drop, the breakout might only signify confusion. It's like when a business suddenly offers a deal. We wonder if it's the right time or a trap. Similarly, a smart trader vets every breakout against its past trend and volume. This leads to the next big point, volume confirmation. A breakout cannot be understood by price alone unless volume supports it. The book says that when the price breaks and volume also goes up, it means both traders and investors are recognizing that movement. But if volume doesn't increase and only the price breaks, it could just be a liquidity trap, a move where you might get stuck. If we relate this to life, it's like someone showing enthusiasm but lacking the conviction to act accordingly, which is what a fake breakout is. Next comes entry point discipline. Often we rush and hit the trigger button when we see a breakout, but the book says the best trades involve some waiting and come with a confirmation candle. That is, the next 1 or 2 candles after the breakout determine whether the trade is valid. Just as you wait for a confirmation call after an interview, here a candle confirmation validates the trade. Now the question is, where should the stop loss be placed? The book says to determine SL from the structure, not from emotion. That is, the resistance or support that existed before the breakout now becomes the new SL. If you entered after breaking the upper resistance, then the SL will be that old resistance which has now become support. This behavior is present in every professional trader. Don't be afraid of small red candles for SL. Instead, pay attention to the entire zone. Disaster strikes when we place SL emotionally. When talking about the risk-to-reward ratio, a 1-to-2 or 1-to-3 setup is ideal for breakout trades. This means if you are risking 100 rupees, you're looking for at least 200 to 300 rupees in potential profit.
Then comes the trailing stop loss. In a breakout, the price often moves rapidly, and this is where a smart trader applies a trailing SL to lock in profits. The book says that when the price moves more than an ATR, average true range, in your favor, you should move your SL up a bit to preserve profit and prevent losses. This practice, i.e. increasing SL with profit, is like de-risking a good business. You increase your margin, reduce costs, and create a layer of protection. It's the same in trading. The real secret of breakouts is patience. Often, a trader sees a setup but doesn't enter, and then regrets it when the price takes off. The book's clear message is to stop regretting and think intelligently. Not every breakout is for you, so create a proper rule. When a breakout occurs, ask yourself, does this move fit my strategy? Have I backtested it? Are both my capital and mindset ready for it? If the answer is yes, then trade. If not, then sit tight. Because not taking a trade doesn't result in a loss, but taking a wrong entry can hurt you both mentally and financially. Chapter 2, Part 1. Behind every successful breakout trade is one thing: identifying the right setup. But a setup only works when it's recognized at the right time. The book teaches us that breakouts don't just form on charts. They form in the mind when you learn to see clarity amidst chaos. This chapter begins with breakout patterns. The book makes a profound statement. It's not enough to recognize these patterns. Understanding their context is crucial. For example, a flag pattern that forms within an uptrend leads to a very strong breakout. But if that same flag pattern forms in a sideways or weak trend, it might fail. So pattern plus trend, track and trust. In a flag pattern, the price moves up quickly, then a small downward sloping consolidation occurs. It looks like a flag, and when a breakout occurs, the price rises rapidly again. The best aspect of this setup is that the risk is small and the reward is large. Like a small opportunity to enter a moving train, where the person who sits enjoys the journey. Now let's talk about the triangle pattern. In this, two lines converge, meaning volatility decreases. The book explains that when the price contracts within a triangle, the market accumulates energy, and once that energy is released, i.e. a breakout occurs, the price zooms. It's just like a racer getting into a crouched position before a race and then starting with a thrust. The real beauty of the triangle pattern is that the breakout can be in either direction, upwards or downwards. So the book advises always trading only after the direction of the breakout is confirmed, not by guessing. Next comes the rectangle pattern, which is when the price moves up and down within a defined range. Many find this boring, but this is the time when the market is preparing for a big movement. The book says consolidation is preparation, meaning where you see the price moving sideways, that's where the real setup is forming. Entry in this pattern should only be made when the price decisively breaks that range upwards or downwards, preferably with volume. Now let's talk about the cup with handle pattern. This pattern is considered a hidden gem in the stock market.
It forms when the price creates a rounded bottom, then a slight pullback occurs, which looks like a handle, and after that, a breakout happens. This pattern tells us that there was first a decline in the market, then a gradual recovery, and now after small profit booking, the real bullishness is about to come. The book considers this one of the most reliable patterns, but only when both volume and trend are favorable.
Now comes the most important question. Where should the entry and SL be in all these cases? The book says that in any pattern, entry above the close of the breakout candle is the safest. This gives you confidence that the price has truly broken that zone. Place your SL where the integrity of that pattern is broken. That is, if it's a triangle pattern, the SL is below the triangle. If it's a flag, slightly below the lower part of the flag. Now comes a powerful statement. Don't rely on the pattern, rely on price action. Often the pattern seems correct, but the price movement is slow or the volume doesn't support it. In such a situation, the book says, no confirmation, no trade, meaning you should only trade when the price action confirms it. Now, with this comes a deep practical lesson: emotional triggers. In trading, when you get excited seeing a pattern, FOMO builds within you. You think, if I don't buy now, I'll miss out on profits. A professional trader recognizes this feeling and controls it. They know that the market will offer new opportunities every day, but losing control over your mind guarantees a loss. So the book says, wait for clarity. Patience pays more than prediction. Then comes entry design. In breakout trading, entry should not just be at the point where the breakout occurred. Most traders keep their stop loss too tight on breakouts, and at the slightest retracement, their stop is hit and they are taken out. The book teaches the next important aspect: risk perception versus reality. When we trade breakouts, there's a fear of getting trapped somewhere, but the book says it's not about fear, it's about market reality. Past experience speaks. So view every trade from a new perspective. Every time, the market is new, and don't let the shadow of past defeats influence current decisions. Here, a strong mental shift is required, from fear to structure. That is, trade based on the system, not on fear. Now let's talk about another crucial topic. Often, people enter trades at the right breakout but fail to lock in profits. They either sell too early or hold on too long. The solution to this, according to the book, is to decide where you'll take profits before you even enter the trade. This could be the last swing high, a Fibonacci target, or a measured move. And yes, it's not essential to close the entire trade at once. Partial exits are also a great way to lock in profits while keeping the movement open. Now let's discuss emotional checkpoints. Every few minutes during a trade, ask yourself, am I still trading my system, or am I operating under emotion now? Because the biggest enemy in breakouts is, the book says, if you don't know your breakout type, you'll be rushing to pick the wrong move. If you don't know your breakout type, you'll be rushing to pick the wrong move. Breakouts don't just come from price movement, they come from the harmony of price and volume. Volume scanning is a master skill. When you're scanning a stock and suddenly it gets 2 to 3 times its 10-20-day average volume, and that stock is trying to break a base, understand that something big is happening. Smart money often quietly takes positions before a breakout, and volume is the clue that shows their footprints. The book has a great line: price can lie, volume never does.
Now let's talk about multi-time frame confirmation. Many people focus on a single time frame, like just the 5-minute chart, but a good breakout scanner is someone who does multi-time frame analysis. If you're seeing a breakout on the 15-minute chart, see if the same setup is supported on the hourly or daily chart. If yes, that move will be more reliable. This is called confluence trading. The book teaches the best breakouts are confluence. You're seeing a breakout on the daily chart. Another very important scanning point is relative strength, RS. RS means the stock is outperforming the overall market. When the whole market is falling, but a stock is going up, or when the market is sideways and that stock is continuously making highs, then that stock is a favorite of strong hands. The book states that you should always scan for breakouts that are running faster than the market. Relative strength is hidden breakouts in comparison. You need to remember this line in every scanning session. Now, let's talk about sectoral confirmation. Suppose you've scanned a breakout, but the sector the stock belongs to is weak, then the sustainability of that breakout becomes questionable. So whenever a stock is breaking out, see if its sector or industry group is also in a strong trend. If both are running in the same direction, that move is more sustainable. This is a simple but powerful edge. The book calls it sector plus stock synergy. Now, another important thing, avoid the noise. You'll find hundreds of breakout news items on the internet every day. People on WhatsApp groups, Telegram channels, and Twitter keep shouting that XYZ stock is breaking out. But the book says to look at 3 signals to measure the strength of a breakout. Candle body size. If the candle body is large and its body-to-wick ratio is good, it's a strong breakout. Volume spike. 150% or more of average volume. Follow-up candles. Momentum should be maintained in the next 1 to 2 candles. If these 3 points align, prioritize that scan. Now, let's talk about creating a routine for daily breakout scanning. For example, scanning pre-market movers before 9:15 a.m. Then from 9:45 a.m. to 10:30 a.m., keeping an eye on the actual breakout candidates. At the end of the day, preparing the watch list for the next day. The book says, you can't win what you can't prepare for. A good breakout watch list is your trading compass. Without that list, you're driving in the market like you've gone out on an unknown road without GPS. And finally, the most crucial thing in scanning is consistency. The book repeatedly emphasizes that you must scan for breakouts at a specific time every day. Initially, you might not find many setups, but over time, your sixth sense for reading charts will develop. Scanning is not finding trades, it's sharpening your trading eyes. Put this line on your trading desk, because when you scan regularly every day, your eyes automatically learn to spot the best breakouts.
Chapter 4, Part 2. Now that you've understood the process of breakout scanning, the next question is, will just scanning be enough? Absolutely not. Scanning is just the first door, but the real game begins with filtering. Not every scanned stock prepares you for a trade. You need to learn which breakouts have real steam and which are just for show. Filtering is an art that blends logic and experience. The book says, first, let's talk about how to protect yourself from fake breakouts. The most common trap is when the price slightly breaches a resistance but immediately comes back down. This is called a false breakout. To avoid this, there are 2 strong rules. The close of the breakout candle should be above the resistance. Don't trust a breakout where only the wick breaks out and the body stays inside. There should be volume confirmation. If there's no volume on the breakout candle, it's just a trap designed to ensnare retail traders. The book says, breakouts without volume are like promises without intent. They will break. Now let's talk about the quality of the base structure. Every breakout emerges from a base. If the base is clean, symmetrically compressed, and shows low volatility, then the breakout is more reliable. Just as an explosion is more effective when there's more compression beforehand, a good breakout is one that emerges from a calm, tight range. The book has a great saying, tighter the coil, stronger the spring. So whenever you scan a stock, notice if it has been in a narrow range for many previous candles. Now, a very rarely noticed but crucial signal. Volume drying up before a breakout. This is a classic logic. When a stock is about to break out, its volume starts to dry up beforehand. Just as the wind dies down before a storm, volume becomes quiet before a big breakout. This is smart money's plan. Whenever you see a stock in a tight base with continuously decreasing volume, understand that something big is about to happen there. Now let's talk about another aspect, the psychology of breakout candles. If the breakout candle is long and larger than all previous candles, that move comes with more conviction. But if the breakout candle is small or indecisive, like a doji, it's better to wait before taking a trade. The shape, size, and position of the breakout candle, everything speaks. You just need to understand their language. Now, I'll introduce you to a secret weapon, which the book calls post-breakout behavior. Many traders enter a trade as soon as a breakout happens, but a true trader is one who waits a bit and observes how the price behaves after the breakout. If the price stays up after the breakout, consolidates, or retests, that's a positive sign. But if the price immediately drops or closes below the breakout, it's better to exit or avoid. The book says breakouts that survive their first pullback are built to run. Now let's move to another important point, volume shelf analysis. This is a bit technical, but extremely effective. Look at the volume by price chart to see where heavy volume clusters are located, just above or below the breakout. If there's heavy volume resistance above the breakout, the price will likely get stuck there. But if there's an empty zone after the breakout, no heavy volume, then the price runs faster. This is called the volume gap advantage, where there's less resistance and the price can fly.
Now let's talk about breakout time zones. Many traders scan for breakouts all day, but the book states that there are certain times when breakouts work better. For example, morning breakouts from 9:30 a.m. to 10:30 a.m., when volume is higher and volatility is active. Power hour breakouts from 2:30 p.m. to 3:15 p.m., when institutions build positions. If a breakout occurs in these time zones, there's a higher chance of institutional participation. Now, the final but most powerful scanning checklist that, according to the book, must be verified before every trade. 1. Is the base clean? 2. Is the breakout candle body above resistance? 3. Is the volume at least 2 times higher than the previous average? 4. Is its relative strength greater than the rest of the market? 5. Is the sector also strong? 6. Is the price holding up after the breakout? 7. Is the risk-reward at least 1 to 2? If more than 5 of these answers are yes, then that breakout becomes a high-probability trade. The book teaches this. Scan less, scan smart, trade less, trade right. The path to success in breakout trading is very straightforward. Clarity, consistency, and conviction. And if you can maintain these 3 C's, no matter what the market does, you'll play by your rules and win on your own terms. Breakout Trading Made Easy, Chapter 5. A battle takes place, and the most powerful weapon in that battle is the entry point. You saw a breakout, like the chart, volume came in, but if you enter at the wrong place, understand that the entire trade can turn against you. The book says your entire trade can turn against you. Inside candle entry. When a small candle forms after a breakout that stays within the previous candle, it's called an inside candle. This indicates a pause and confirmation. If a breakout occurs above the inside candle, it's considered a very clean entry. Your stop loss can be set below that inside candle, making it small and effective. Predefined trigger levels. Now let's talk about predefined trigger levels. Traders' biggest mistake is acting on emotion in a live market. When a breakout comes, there's fear. When a breakout doesn't come, there's impatience. That's why professional traders predefine their entry levels for every setup. For example, if XYZ stock closes about 230.50 for 15 minutes, I will trigger. This brings clarity and makes the trade mechanical, not emotional. The book says mechanical entry is the antidote to emotional disaster.
Position sizing. Let's talk about position sizing. No matter how correct your entry is, if your position size is wrong, the entire trade can go south. How do you determine your position size? 1. Don't risk more than 1% of your total capital. 2. Find the difference between the breakout and the stop loss, SL. This is your risk per share. 3. Then divide your 1% capital risk by that risk per share. That will be your quantity. Example: if your capital is 1 lakh rupees, or approximately $1,200 USD, and you want to risk 1%, which is 1,000 rupees, or approximately $12 USD, the stock's breakout is at 500 rupees, or approximately $6 USD, and your SL is at 490 rupees, or approximately $5.88 USD, meaning 10 rupees, or approximately $0.12 USD risk per share. Then 1,000 divided by 10 equals 100 shares. This will be your correct position size. Partial entries. Now, a new concept: partial entries. If you're unsure whether a breakout is genuine, don't take the full quantity. First, take 50% of the quantity and add more upon confirmation. The advantage here is that if the breakout fails, your loss is halved. And if the breakout continues, you ride the movement. This is a game of reflexes and discipline.
If the price moves above the breakout level and stabilizes, forming a small range with decreasing volume, be cautious. In such situations, we need confirmation and patience. This is where the trailing stop-loss entry confirmation model comes in. Here, you don't place an immediate SL below the breakout. Instead, you trail the SL according to the price structure. Suppose you entered a breakout at 500 rupees, or approximately $6 US. Your SL was 490 rupees, or approximately 5.88 USD, and the price went to 510 rupees, or approximately $6.12 USD, and then consolidated a bit. Now you can trail your SL up to 500 rupees. This offers two benefits. First, you avoid losses, and second, if the trend continues, you can capitalize on the entire move. Many times, new traders get scared and close their trades after a slight dip in price post-breakout. But the book clearly states, pullbacks are not failures, they are tests. It's normal for a small dip to occur after every breakout, known as a pullback. If the price retests that old breakout level and bounces again, it's a sign that the trend is intact. Volume confirmation. This is where volume confirmation comes in. When the price breaks out, but the volume doesn't follow, it's considered a weak breakout. A true breakout occurs when volume and momentum are all in sync. Multi-time frame entry confirmation. Another pro tip: if you're trading on an hourly or 15-minute time frame, always check the higher time frame, meaning the daily chart, at least once. If the daily chart is also in an uptrend and an intraday breakout has occurred, the success rate increases significantly. This is called multi-time frame entry confirmation.
Breakout candlestick psychology. Now let's talk about breakout candlestick psychology. The book mentions that candlestick patterns also help a lot in refining entries. Some key candles to pay attention to: Marubo Zoo candle. No wicks, full body, shows strong momentum. Bullish engulfing candle. A green candle that completely engulfs the previous red candle, signaling buyers with high conviction. Doji after breakout. A sign of indecision. Be cautious. By observing these candles, we can decide how much control buyers have at the entry point. Avoiding fakeouts. Let's discuss ways to avoid fakeouts. The biggest problem is false breakouts or fakeouts. This happens when the price goes above resistance but then falls back down and returns to the old range. To avoid fakeouts, 3 tests are essential. 1. Closing confirmation. Don't consider a breakout just by a wick. A full body candle close is essential. 2. Volume spike. A breakout without volume is ineffective. 3. Follow through. The momentum should continue for 1 to 2 candles after the breakout. Breakout and relative strength.
Sometimes prices move with the overall market, but some stocks break out even when the market is falling. These are called high relative strength stocks. It's better to trade in these as their demand is strong. For this, you can compare them with the Nifty or Sensex, because if everything else is falling and this one is breaking out, it can be a very strong trade. Time of day entry optimization. The book also mentions another method, time of day entry optimization. Most breakouts work well during two periods. 1. Opening range breakout, from 9:15 a.m. to 10:30 a.m. 2. Power hour breakout, from 2:30 p.m. to 3 p.m. Institutional participation is higher during these times. Don't enter when you feel like you should. Enter when your system tells you you should. That's the difference between a professional and an emotional trader. Chapter 6, Part 1. Every successful trader has a secret weapon, their stop-loss strategy. People think a stop-loss means losing, but the truth is, a stop-loss is a protective shield that saves you from big losses. The book begins with this line: "You don't go to war for fighting, you go for your shield. A stop-loss is your shield." Now, the question is, where do you place a stop-loss? How far should it be, so that the trade has room to breathe and your capital is also protected? Structure-based stop-loss. First, let's understand a structure-based stop-loss. Here, you place the stop-loss according to price action. For example, if a stock breaks resistance and moves up, your stop-loss will be below that old resistance, which is now acting as support. Or if an uptrending stock has a small pullback and you enter on the pullback, your SL will be below the lowest point of that pullback. The logic behind this is that if the price breaks the structural level you set, your entry becomes illogical. This is a mechanical method that saves you from emotional decisions.
Volatility-based stop-loss. Now, let's talk about a volatility-based stop-loss. Some stocks are very volatile and some are very calm. In a volatile stock, if you place a small stop-loss, it can easily be hit. This is where ATR comes in handy. ATR shows you the stock's average daily range. The book suggests keeping your SL 1.5 to 2 times the ATR away. Example, if your stock is trading at 200 rupees, which is approximately $2.40 USD, and the ATR is 5 rupees, which is approximately 6 cents USD, your SL should be 7.50 to 10 rupees, which is approximately 9 cents to 12 cents USD, away from the breakout point. This gives the stock enough room to move and prevents unnecessary SL hits. Percentage-based stop-loss. Another popular method is the percentage-based stop-loss. Here, you don't risk more than a certain percentage of your total capital. For example, if your trading capital is 1 lakh rupees, which is approximately 1200 USD, and you want to risk 1% on each trade, your maximum loss can be 1000 rupees, which is approximately $12 USD. After this, you find the difference between your entry price and SL price and calculate your quantity accordingly. This method protects your capital and saves you from big setbacks.
Keeping SL loose enough. Some traders keep very tight SLs. The SL gets hit with even a slight movement. The book says, give the market room to breathe. Your SL should be far enough for the stock to make normal movements, but not so close that it gets hit by slight volatility. Maintaining this balance is an art that comes with experience. Exit strategy. Now let's discuss exit strategy. If entry is the battle, then exit is the final step to winning that battle. Many people know how to enter, but they don't know when to exit. This often turns small profits into big losses or reduces large profits halfway. The book emphasizes you must have a plan to book profits, just as you have a plan to limit losses. There are 3 types of exit strategies. 1. Target-based exit.
For example, you entered at 200 rupees, approximately $2.88. Set a target of 240 rupees, approximately $2.88, and booked your profits there. 2. Trailing exit. Gradually moving the SL up to capture the trend. 3. Time-based exit. If there's no movement in 3 days, exit. No questions asked. A target-based exit is predictable. You know where to get out. A trailing exit is flexible. If the trend continues, you continue with it. A time-based exit gives you peace of mind, especially when the trade is going sideways. Exit psychology. Now let's understand exit psychology. Many times people exit in a panic. As soon as the price drops 5 rupees, approximately 6 cents, they get scared and get out. Or, due to extreme greed, they never exit. The price went from 240 to 260 rupees and then dropped to 220 rupees. The book teaches to always ask these 3 questions when exiting a trade. Is the reason for my entry still valid? Is the price structure still intact? Are volume and momentum still in sync? If the answer to all 3 is no, then the exit is justified. Many times you have to make partial exits. For example, the price reaches 240 rupees, approximately $2.88. You exit half your position and hold the rest for 230 rupees, approximately $2.76. This locks in your profits and keeps you in the trend. And yes, one thing is very important. Never make a revenge exit. That is, when the market has hurt you, emotionally cutting off the entire position is wrong. An exit should be a calm, thought-out step, not a result of fear or anger. By now, you've mastered entry, SL, and exit strategies. But to win this game, you need not just a system, but also an extraordinary mindset.
A trader's biggest enemy isn't someone else. It's their own mind. When you create a system, the chart, and then when the price goes in the opposite direction, you move your SL, increase your quantity, average down because your ego refuses to accept it. The book teaches us, don't marry your trade. Your job is to maintain objectivity. Not too much trust, not too much doubt. Trap 4. Impatient mindset. You take a trade and want results within 5 minutes. It's crucial to give the price time to reach its level. The market isn't a vending machine where you drop a coin and get results. The way to overcome impatience is to set clear expectations with every trade. This trade is for 1 or 2 hours. I want this much movement. If it doesn't happen, no big deal. Fear of past losses. After a bad trade, many traders withdraw into a shell. They feel the next trade will also be a loss. And because of this fear, they don't take an entry even when there's a correct setup. If you accept losses mentally, your brain will stop making decisions. Remember, a loss is a cost you have to pay to learn trading. Every loss is a lesson if you can view it with logic instead of emotion. Now, let's talk about the mindset that will keep you centered and focused on every trade. Be process-oriented, not outcome-oriented. Don't think about how much money this will bring. Think about whether you followed your process, if your entry was correct, if you planned your SL, stop loss, and position size, and if you followed the rules for exit. If yes, then whether there was a profit or not, it was a successful trade. Profit trade is your business, not your identity. You are a good trader even if your last 3 trades were losses. Detachment teaches that every trade is a probability, and one trade doesn't define you. Profit trade is your business. After every trade, don't just write down numbers, also write down how you felt. Was there fear or excitement when taking the entry? Was there relief or guilt after the exit? This emotional journaling helps you recognize your pattern, and that's the first step to improving your psychology. Take breaks. If you're consistently losing or your mind feels scattered, it's important to take a break. No system or strategy works with a tired mind. Reset yourself with a break so you can return with new energy and clarity. Celebrate process. Every time you discipline yourself to exit at the SL, stop loss, celebrate it. Every time you didn't take an impulsive trade, celebrate it. Every time you follow the rules, even if there was no profit, celebrate it. Because these small victories make you consistent. A line from the book that fully applies here is, winning trades don't make you a winning mindset does. So far, you've learned how a pro trader's thinking rises above fear, greed, and ego. Behind every successful trader, there's a common thread. They created a system and then followed that system for years. The book states there's no common thing behind your trader. It's about a process. Now the question is how to build a strong trader. Any system consists of 4 things: setup, entry, risk management, and exit. The clearer these 4 pillars are, the stronger your system will be. First, let's talk about setup. A good breakout trading setup is where the price first forms a clear base, meaning consolidation, and then gives a sharp breakout on volume. That is, you see a stock moving in a fixed range for the last 10 to 15 days and then suddenly breaking a resistance. Now here people often get confused. Is every breakout truly genuine? No. So it's important that you create some conditions with which you can catch the right setup every time. Let's say your setup could be like this. The stock has consolidated in a narrow range for at least 10 days. The breakout candle is larger than the previous 5 candles. The volume on the breakout day is at least double the average. The breakout is also visible on a higher time frame, such as happening on the daily chart and giving confirmation on the weekly chart. Now let's talk about entry. Entry should be at a place where the risk is low and the reward is high. The ideal entry is above the high of the breakout candle, but waiting for a confirmation candle can also be crucial. Many people enter as soon as the breakout candle closes, but sometimes that very candle turns out to be false. So the book advises, after a breakout, if the price retests a bit and then bounces, the entry is more reliable. Now comes risk management. This is where 90% of traders give up because they only think about entry and profit, not SL. A good trader first defines the loss, then takes the entry. So whenever you take a trade, first think, if this trade goes wrong, how much money am I ready to lose? The ideal risk should not be more than 1% per trade. That is, if you have 100,000 rupees in capital, you can only bear a loss of up to 1,000 rupees per trade. Now it's important to know where your SL will be. In a breakout trade, the SL is usually kept below the base from which the breakout occurred. If the breakout is from a strong support, then the SL should be below that support. Now think for a moment. You bought a stock at 200 rupees after a breakout. The base was 190 rupees. Then your SL will be at 189 rupees, meaning the risk is 11 rupees.